Hello, Finimizers. Welcome to another Finimize Live. For those who don't know me, I'm Carl Hazley, VP of Content here at Finimize and host of your session today, Future of Finance, Acquiring Next-Gen Investors, presented by Finimize for Business. A few housekeeping things before we get into our conversation. Please use the chat to introduce yourselves. Let us know where in the world you are listening in from. And remember to switch to all attendees so that everyone can see your greetings. In terms of the session, we're going to have 15-20 minutes of sort of hosted conversation with myself, Liza, and Brian, who I'll introduce shortly. And then we'll have some time for Q&A. So please use the Q&A box rather than the chat box to ask a question. If you see a question you like or that you wanted to ask yourself, give it a thumbs up. I will sort the questions by most upvoted Reddit style, which is a trending topic at the moment. And we will put those questions to our esteemed panelists in the second half of this conversation. So that's the housekeeping. Let's kick things off. For those of you who are new to Finimize, today's event is brought to you by Finimize for Business, which is our promotional and content platform that has helped over 300 financial institutions attract, retain, and engage with modern investors, thereby boosting engagement and revenue with content that converts. Through our network of partners, Finimize content reaches over 40 million individual investors globally. Please check out finimize.com/business for more. And while you're there, check out the Q2 Modern Investor Pulse, which is our latest check-in on our a subset of thousands among our million-strong community. It shows how they're feeling about markets, how they're planning to invest, and should be an important part of how you go about and plan your engagement for the weeks and months ahead. Now, enough about that. Let's get to our experts. I'm delighted to introduce two fantastic panelists for our conversation today. First off is Liza Landsman, CEO of Stash, the pioneering fintech company that empowers everyday Americans to invest and build better lives. She has a wealth of experience, having previously served as general partner at NEA, president at Jet.com, and CMO at E-Trade, among several other impressive roles. And she is joined by Brian Barnes, who is the founder and CEO of M1, a personal finance platform that lets you earn, invest, spend, and borrow with more than $8 billion in assets under management. M1 helps hundreds of thousands of people with their wealth using powerful automation tools. We're going to hear more about that shortly. M1 has raised somewhere around, and correct me if I'm wrong, Brian, I'd love to have up-to-date stats if mine are out of date, about $325 million at a unicorn plus valuation. So, expert panel. We also have expert attendees here today. We've got founders, C-level execs, senior leaders from across TradFi, FinTech, startup, and Liza and Brian, they are keen to hear from you. So let's make this session as hands-on and practical as possible so everyone leaves here with a notebook full of insights to take their work to the next level and impress their bosses. Attendees, just a reminder, let's use that Q&A box, ask questions. We will get to the most upvoted ones before too long. So, Liza, Brian, thank you both for joining me today.
Great to be here, thanks.
I wanted to start by giving the audience a clear understanding of your respective platforms' place in the world. And what I mean by that is, we know modern investors tend to use multiple platforms at different stages of their investment journeys, from buying their first stock through to setting up their set it and forget it portfolio. So what's your place in that ecosystem? How do you serve investors in that space? Liza, maybe I'll start with you.
Sure. We are really here to support truly low and middle income US consumers. So typically average household income around 60,000, which is pretty much in line with the median income of the US. We are almost always the first place that these consumers are choosing to invest, and they are coming onto the platform not with a large amount of aggregated assets. They're often starting with us with as little as $50 to bring onto the platform, but it grows steadily over time. So we really think about our place in the universe as helping address a really underserved but really large market at the beginning and middle of their journey, particularly because we know one of the things that is hardest to get people off of the sidelines is a sense of confidence and their ability to kind of push through a lot of the more confusing and complex language that has tended to plague our business.
Very clear. Appreciate that. And Brian, where's M1's position in the landscape?
Yeah, I think we skew a little bit sort of further down the wealth building trajectory that Stash may offer. And so our target customer generally has 5, 6, or low 7 figures of investable assets. And, we're trying to help them build wealth over the next multiple decades so that they can move, order of magnitude or more up that wealth journey curve. And so we offer a comprehensive financial platform to do that across yield on cash, automated investing platform, high cashback credit card, and different ways to borrow money. And really serving a self-directed investor who says, I want a little bit of control over how I manage my money, but then use software and a platform to automate a lot of those day-to-day choices so you don't have to manually tinker with things or pay a high-priced advisor to do it for you.
Awesome. So combined, you guys, both your platforms have over $10 billion of AUM, which for companies both less than 10 years old, I think is to be commended. So for other founders and fintechs looking to emulate your growth, I guess the $1 million question, and we're getting to it early, what's the secret behind that success? And maybe to narrow it down a bit, what channels are working to drive that growth, and particularly ones that I guess maybe incumbents in the space are paying less attention to? Brian, maybe I'll start with you.
Yeah, so I wish there was a silver bullet that you could just fire out one channel and be done. Truthfully, I think it is easier to create compelling marketing in the space than it is to create a compelling product experience. And so I think it's harder to differentiate yourself in the marketing landscape of, everything sort of looks plus or minus 10% better or worse than your alternative competitor. But then from a product experience, I think that there's a evolution that should take place where, finance apps are as good as every other consumer app in non-financial ecosystem. And so that's really where we try to prioritize our efforts, is just creating the most compelling user experience or client experience writ large, whether that's the actual value of the platform through price and automation, or the user experience, how people interact with the app. The nice thing in today's age is, when you have $250,000 and you're looking where to put it, it is more of a considered purchase. And so people will seek out advice online. They'll go to YouTube, they'll go to Reddit, they'll talk to their various friends. And so trying to be the best platform on the market, and having that be a recommended solution as people seek out what to use to manage the vast majority of their wealth, by and far is better than any marketing that we've ever done. And so we try to anchor on, really driving organic word of mouth or acquisition rather than dominating a individual channel.
Gotcha.
Yeah,
So
I know it's super boring when panelists agree with each other. However, I will say on this front, it is really true. There is no one silver bullet on acquisition channel. You've got to do the blocking and tackling and work your funnel and think about being efficient on that front just to create the level of awareness and exposure. But truly in our category, the products really have to do the hard work, because it is a place. I mean, you think about how concerned people get when they don't know where their pizza is for 5 minutes. Like, you can't have that relationship with a product that is helping you think about and care for your money. So the product really has to sing and be crisp and clear and super helpful. And if you think about sort of the journey the industry has been on over the last decade, I think holistically, it's gone from a product experience, god awful, to just not terrible. We're still probably in the Wright brothers phase of how much friction can we pull out? How much jargon can we like abstract from the experience so that people who want to make very concrete choices or be helped to make choices can really understand what they're engaging in. I think that's part of our secret sauce as well. There are some things that we do that are more specific to us and particularly are helpful when you're targeting people who are earlier in their journey as investors. So things like stock parties, where we help introduce both our customers and prospects to particular equities or ETFs to help bring those things to life for them in more human terms. It also can help us from a viral perspective, have friends invite friends. And it's really the phenomenon Brian is talking about, which is your customers can be your best advocates if they really love, appreciate, and are finding value in your platform.
Fantastic. So product first, and then sort of organic word of mouth. I guess when you say stock party, I'm picturing almost like kids having a chickenpox party where you want everyone to catch the stock bug and then go off and tell all their friends about it.
I mean, I don't really love likening something we're doing to a viral infection, but I guess the analogy works.
Okay, cool. Well, I won't repeat that.
Thank you.
Cool. I can just hear the sound of everybody scratching TikTok off their notepads as they've been listening to that conversation as the silver bullet. Brian, I want to pick up on one thing you mentioned. And apologies for picking on your example. You gave the example of somebody with $250,000 that they're looking to put to work. I guess the assumption in that example is that's after a life event. They've had some sort of windfall of some sort, or there's a shift in circumstances. And I guess the hard thing about investing in that world is those major life events are few and far between. Once every few years, you think about. I was going to say every few years you think about your mortgage, which is a very UK perspective. But maybe every few years you think about your pension, or there's a liquidity event of some sort. So in that sort of scenario, how do you drive engagement with your platform, with your clients? What features do you find are most popular and get people to come back and stay engaged, month in, month out?
Yeah, so at one started on the investing side of the equation, and so that's what we're best known for. But we've since broadened and have a sort of total comprehensive personal finance platform, and really every financial sort of point solution or need, they each have a frequency of engagement, and it can go from every single day. People swipe a debit card, credit card on average once a day, to checking your savings account where you're depositing in 2 times a month with your paycheck, maybe doing a few bill pays a month with your paycheck, to investing. You might be changing your investment horizon once a quarter, once every 6 months, once a year. And then, like you mentioned, you're sort of borrowing opportunistically of college or home or car. And so really we look at sort of, we're helping someone manage their finances, and we need to help everybody from the day-to-day interaction all the way to the long-term sort of wealth building, once every 5-year type aspects. We have tried to anchor on, as opposed to trying to get a demographic that is doing, learning this for the first time or changing the behavior. Truthfully, like the people that already geek out on this kind of stuff, and so they're watching CNBC, they're getting the Wall Street Journal, they're in a investment forum online where they talk about various ideas. And so because we are young, we have tried to anchor around the people who are already excited about this, who get it, who thoroughly enjoy the aspect of optimizing their finances, and then trying to tee them up with the platform that we think best allows for that. And so it's a long-winded way of saying, but we offer day-to-day tools, we offer the once every 5-year tools, and we're trying to offer a platform that really engages the person who is the sort of personal finance nerd, so to speak.
Gotcha.
And look, I think actually if you think about the other end of the spectrum, interestingly, I just read this survey and it was very compelling to me, given Stash, but a little sad to me as a human, which is that Americans think about money more times a day than sex. And so I think because in the piece of the journey that we are really supporting our consumers through, while we're a subscription business, so we don't need for people, given the service we provide for them, to kind of be engaged every day. People do really like to visit their money. And so we certainly have things we do like auto stash, which allows people to set up a regular recurring deposit, and our smart portfolio, which is our award-winning robo-advised piece of the platform, and our debit card, which brings stock into their real life because every time they swipe, they get fractional shares back to help build their portfolio. So every small action they're taking kind of is both wealth building, but is also engagement building, because it sort of brings it all back to these kind of small, consistent steps you can take over time to help build wealth if you haven't already achieved it. But I do think it is on people's minds all the time. And so what we're trying to do is help them relieve that anxiety through action.
Got you. I think on that depressing survey you read, that ties in a little bit with the is it Gen Z or millennials that are having less sex than prior generations? But that seems to tally.
I think I've read that, but I am not a Gen Zer, so I don't have any data on this subject.
Maybe sticking with you for a moment, Liza. I guess one of the biggest challenges we have in society is to get more people investing. And I think you've been really successful at that. Can you maybe break down what it takes to get somebody from zero to confident in investing? You know, what are the big barriers that you can break down? What's the industry getting wrong here? And you know, thinking maybe for a second beyond Stash, you know,
Yeah.
If you were in the White House, how would you change this for all of America?
I think the frame that the industry has created over the last several decades is one that purposefully has created a velvet rope atmosphere around something to which arguably every person should have access. Right? As you think about equity markets as an example, as the single greatest source of wealth creation, why should there be a minimum threshold of education or economic wherewithal that would deprive you of accessing the thing that could actually make your life better and more secure? And so what the industry has gotten wrong is that it hasn't fought hard enough against those points of friction. And I would argue in some instances, sometimes unintentionally, we've created more needless complexity. Whether that is in, just think about all of the things you have to sign to become an investor, to open a bank account. I've just gone through this with my kids who are recently out of college, well-educated, very exposed. And when they were starting to try and open some of these things independently, it's insane what we expect people to be able to parse. And so removing as much friction from those things as possible, I think, is critical for actually delivering on the access that fintech has long promised to the world. If I then click in and look at it at Stash, we've kind of taken a two-pronged approach. One is to help people learn by doing. So whether that is our stock-backed debit card as an example, so people are getting to experience equities and live the Warren Buffett, stream of thought, which is invest in things you know. What could be better than if you're buying your groceries at Walmart and swipe your debit card, earning shares in Walmart simply for buying your groceries there? And it brings these things to life for newer investors in a way that very few other things do. But it's also through having all of the nudges on the platform guide toward what are great lifelong habits for wealth creation, which is both cost dollar averaging, so diversity of time, and then diversity of holdings. And that's really what we're focused on delivering in the simplest fashion possible, without all the bells and whistles around everything else that sometimes can be inhibitors from getting people off the sideline.
Gotcha. Brian, do those barriers change meaningfully when you go sort of up the wealth curve? So I guess I'm thinking because you offer sort of a range of banking, lending, borrowing services, what's the sort of roadmap to get people from cash into investing? Is that a path often traveled? And again, what are the barriers you see there?
Yes, I think that's the path most often traveled. And, I think most like the wealth curve of most Americans as you graduate high school or college, either $0 or in debt. People sort of build wealth until their retirement age, 65, 70, whatever it may be. They might have, $1 to $3 million at that time, and then they draw down in retirement. It's sort of, the ideal middle class, American standard of living of you're building wealth over the 45 years of your career and then drawing down in retirement. And I think your financial needs grow and become more complex the further along you are in that wealth journey of, early on you need day-to-day checking and debit cards, you might need access to credit, you might need budgeting tools, and then over time as you start to build wealth, you need asset management tools. And so it really is having a platform that provides multiple curves, and I think we try to look for people on that inflection point of going from sort of day-to-day money management to starting to really think about building wealth in a material capacity to fund their lifestyle over many decades, and trying to get the affluent 35-year-old who's going to be the affluent 55-year-old over periods of time. I think there's on a lot of like beneficial habits, I think a lot of people actually know what to do. It's sort of always easier said than done of, people know like to eat, like if you take it to health, they know what it means to eat healthy and they know what it means to work out. It's sort of, the systematic habits of doing that. And that's where I think automating your decisions have a huge consequence in that if you are required to manually do every single step, you just have to systematically remake the decision like day in, day out, over and over and over again. And like if you forget one time that you say, screw it, whatever, versus saying, I'm going to save 15% of my income and I'm just going to auto put it into an IRA until that's maxed out, then have that go into a taxable account. The second that you automate the decision, you have to opt out of it. And so it just happens in the background. And these beneficial behaviors, you don't have to muster up the courage and the motivation to do it. It just happens in the background of life. And so I think that is an area where, sort of when someone's calm, cool, collected, thinking about their finances over a period of time, creating a plan and being able to set the rules as much as possible and just say, do this until I tell you differently, and then sort of have the beneficial behaviors be automated in the background of your life.
Awesome. That's really helpful. That's really clear. We are coming up on time, so I want to throw it open to some of the audience questions in the 5 minutes we have left. So please use the Q&A box and upvote any questions that you like the look of or that you wanted to ask yourself. I'm sacrificing my next question, which was, what's the path to 1 trillion in AUM? So if anyone wants to put that in the Q&A box and upvote it, be my guest. But first question from
I feel like I want to just answer practice to that, but that's
let's see. Hopefully somebody in one of our esteemed listeners or viewers will ask that question again. How do you balance the RIA, that might be IRA side of the business, and the brokerage side of the business? Regulation is high in this industry, and how do you make it clear to your clients that they're moving from one side to the other? I think that might be for you, Brian.
Yeah, so it likely is RIA, we're registered investment advisor. It's the way that in the United States, people offer investment advice, and you're more paying for as opposed to just like the strict execution to enact your financial wishes. You're actually paying for the advice and for the investment advisor to help out along with it. It is incredibly tough. We found it easy to operate in the fully self-directed realm or the fully advised realm, but blurring the lines becomes truthfully, very, very difficult solely for compliance reasons, even if we think it will be beneficial to the end user. And so has been a little bit of frustration in dealing with that. Truthfully, the way that we have, sort of dealt with it is we operate 100% in the fully self-directed realm. So the M1 platform, we view ourselves much more as the platform, the tool to enact what you want to do with your money. We are not making investment recommendations or providing advice. We're really just automating the choices that you put into the overall platform.
Cool, very clear. Another anonymous attendee, possibly the same one. What advice would you have for an aspiring fintech entrepreneur at an earlier stage business starting to scale? What's the most important thing to focus on, and how has that shifted for you now? Liza, maybe I'll come to you first on that.
Unquestionably, and we both talked about this earlier, the most important thing you can focus on early stage is establishing great product fit to market. Obviously, you want to be a good custodian of capital. You want to hire a good team. You don't want to hire too far ahead of your revenue. But the most important thing to get right in the first 2 years of your existence is getting enough reps under your belt with getting your product out in front of whatever the profile of your end customer is, that you have real confidence that you are solving either an unmet need or you are solving better an existingly met need in such a way that it will be compelling in the long term, both for consumers and people who might invest in you. If you don't have that, anything else you have is kind of an interesting side note.
Cool. Brian, anything to add there?
Totally agree with everything said. Like, building a company, it's easy to look at a company that's 20 years old and sort of all the things that they do. And, if you sort of go back in time, that started from like an idea or a PowerPoint, and you really do have to systematically go and build all those things. And like, I think the tough thing is you have to show value along the way. You can't just build in a vacuum forever and then, catapult up to that giant organization. Maybe the one thing that I would say is, fintech was probably underfunded and overfunded, and now it's probably, back to being underfunded. And so I would say the likelihood that there's the capital availability that, M1 and I was the benefactor of is unlikely to be there over the next couple of years. And so I'd say showing true substantive traction with a, realistic business model that your customers are funding the growth is likely the path that's going to be needed, rather than build on venture dollars and do the business model later in the evolution cycle of the organization. So I think it's just, we're in a very different macro environment than we were 5 years ago.
Yeah, very clear. We could go on for ages. We have, I think, 10, 11 more questions. That's not even counting my $1 trillion one. But I'm afraid that is all we have time for today. Liza and Brian, this has been fantastic. I've learned so much in such a short space of time. So thank you so much for joining us today. And I hope everybody has found this as enlightening and informative as I have. To our attendees, please fill out the feedback form that will pop up on your screens as you leave the Zoom. And yeah, as I said up top, to see some further details around the stats we've mentioned in this discussion or talked about up top, please visit finimize.com/business. Check out the Q2 Modern Investor Pulse, and please get in touch with any questions. And I look forward to seeing as many of you as possible at the next event. Thank you very much.
Thanks all.
Thanks.